What is going on, guys? I am Chase. Welcome back to Intelligent Money Investing. And today we are going to talk about why your current dividend yield on a stock does not matter. Before we get into that, I want to welcome all of the new subscribers. Thank you guys for joining the channel. Ask you guys to please drop a like on this video. All the support lately has been absolutely fantastic. So if we could keep that up, that'd be so cool. Just welcome you guys again. Now let's get into this. So I've got a few examples today that I want to talk about why your dividend yield really is not that big of a deal on your stock. What's really more of a big deal is the growth of the company and the growth of that dividend. So let's say you have a company that pays out, let's say a 5% dividend, but it's pretty much taking out all of its cash flow, like that's all of its free cash because it's trying to keep up with that dividend. And then it doesn't have extra money to reinvest in the business and then grow those profits over time because that's what you need to be able to grow your profits. You need to invest that money back in. So it's kind of like what Amazon does, what Apple does for the most part, even though they do have a small dividend yield, what Berkshire Hathaway does. A couple of those examples have zero dividend yield, but you really need to have some free cash flow to be able to reinvest and grow that business because you can either get $5 today or down the line you could be getting $20 a year in dividends and stuff like that. So I'm going to give you guys a few examples here and kind of show you guys examples of why this is a true statement. So first one's going to be AbbVie Pharmaceuticals. This actually does have a pretty high dividend yield right now. I think it's sitting around 4%. At 2.7% on here, but I actually do believe that's wrong. Robinhood has its dividend yields off a little bit, and it did just raise its dividend recently to 96 cents per quarter per share, which is pretty cool. But really, when you buy AbbVie, like I think I bought into AbbVie at about a 3% yield, and while the share price has been absolutely skyrocketing, up 50% in the last year, that dividend also has been. So when I bought in, I was getting about, I believe, 57 cents a share, maybe 64. Then they raised it to 71 and now up to 96 cents. So if that trajectory continues, I've already been given like a 40-50% raise on my dividend. So when you think about that in the long run, when you're relying on these dividend yields, this dividend income for your life to be able to live on, if you can get a raise every year with that dividend, that's really what matters. And then you can live a better lifestyle as you get older. You can have a little bit more free cash flow rather than just having a flat income. You really want to have a growing one as you get older, and the more it grows, the more you can reinvest, and that's just a strong positive sign that your company is healthy and it's going to continue to pay back dividends going forward. So the next one I'm going to talk about is a pretty much opposite example, and that's going to be talking about GE, General Electric. So GE was a long-running dividend company, had about, I believe it had gotten up to about a 5 or 6% dividend yield, and that's absolutely plummeted this year down about 50%. But that dividend was absolutely slashed, cut in half. So the people that were relying on that dividend for their expenses, for their lifestyle, for to put food on their table, just had the money taken in half that they were receiving every year, every month, or every quarter. I mean, so that's just an opposite example that really the health of that company wasn't good, and that dividend went away just like that. It's not like the company has to go out of business. They're allowed to do whatever they want with that dividend. So the board decides to slash it, and then the shareholders are pretty much screwed that are relying on that dividend income. But it's something that had to happen for the health of the company. So hopefully that can turn them around in the long run, not having to pay out so much. But in the short run, absolutely it's painful for investors who are relying on the income and want that income to be boosting their stock. And it's a really big reason why a lot of people get into GE because of that big dividend. So that's really why the health of the company needs to be there in order for the dividend to really matter. Another one we're going to talk about, it's a little bit negative, is going to be Centrelink. Centrelink's got about a 13% dividend right now, which is absolutely insane. So when you're paying out this much money that the dividend might be in trouble. There's a lot of stories the dividend might get slashed for Centrelink because it is so high. 13% is the highest in the S&P 500. And even with the REITs that have to pay out about 90% of their profits in dividends, don't even get close to Centrelink's 13% dividend yield. So that's another thing you guys want to notice. When a company is paying out so much that they're not going to have room for growth. So even unless they're the most profitable business ever, which I don't believe Centrelink is, that when you're paying out this much, a really big thing to pay attention to is going to be the payout ratio, and that's essentially their profit to dividend yield payout ratio. So let's say they're paying out 100%. That means they have a zero extra profit to put back into the company. And sometimes that can your payout ratio can even be over 100%, meaning that you're taking on debt in order to pay out that dividend and try and keep it up. Because if that dividend gets slashed, it's usually a very bad sign for the company. And usually there's some huge equity losses right after a dividend gets slashed. I believe when GE's dividend was slashed, it fell like 10% in 2 days, which is a pretty big deal. So Centrelink is going to be one you want to be careful with because 13% is ridiculously high. The S&P 500 average is about 1.8, 1.9, maybe 2% on a bad day, but this is ridiculously high. And while this would be awesome if it was sustainable, if it was a good dividend that is going to be sustainable in the long term, but Centrelink, the kind of technology is starting to go out of favor. The company's been shrinking, down 30% in the last 5 years, 20% in the last year. So company hasn't been great over the last half decade. So we'll see how that goes. But it's really one you want to be careful with, especially when you see those high dividend yields. It can be a little scary. That's something you got to watch out for. And the last one we're going to talk about is going to be Apple. And Apple's another dividend growth one. And it's kind of a big deal because Apple, the old philosophy was that Apple was never going to pay a dividend. And they said that paying a dividend is a sign of a company that's not growing anymore and a sign of a dead growth company. But obviously, that's not the case, as since they started paying dividends again in 2012, well, we won't even have that on here. They're up over 194%. So really, Apple's been a huge growth company, and we know that they're on the cutting edge of so many technology products, like what I'm recording on this right now, a MacBook and an iPhone. But they're on the cutting edge of so many products, so they're able to reward their shareholders. But it's in a small and kind of like it's about a 1.5% dividend right now. It's kind of small, but it also is growing and growing. Like they have dividend raises pretty much annually now, which is great. They have a huge cash pile right now, so we're not worried about that dividend going away anytime soon. I believe they're going to keep continuing to raise it and more in the long term, but they're going to keep that dividend relatively low because they want that extra cash to be able to reinvest in the business, and that's what you want out of a company. You want a company that has ways to reinvest their money. That way, they're going to see more profits because they're going to get a better return likely as a big business with that investment than you are being able to invest in the stock market or something like that because they can get pretty huge returns off of their products, their research, and that's something that when you have the capabilities of a company like Apple, that's something you want to have. You want that company investing that money for you, and that's why Berkshire doesn't pay out a dividend. Their philosophy is that they can get a better return with that money than you can, and that way they can grow the company, and you as a shareholder are going to reap the rewards of that rather than doing whatever you want on your own, and Berkshire kind of suffering from not having that cash flow. So that's all I've got for you guys today. I hope this has kind of enlightened a few of you guys about whether you should be going for dividend yield or if you should be going for dividend growth. I do have a video of a few dividend growth stocks that are going to be great for 2018 and beyond, in my opinion. So you guys should go check that out, and I will see you guys in the next one. Thanks for watching.